Hello, everyone, and welcome to our May monthly investor discussion. Today, I'm joined by JR Gondeck and David Sokolovsky. And what we want to really cover is go over what's happened the last month, 6 weeks or so. As everybody's noticed, markets have been in a bit of turmoil, and we want to just kind of dig into the reasons why, at least from our perspective, that we're seeing those types of moves in the market, as well as how to really try and invest within this type of scenario. We're looking at really most asset classes have taken a step lower, this year, and it's really about how to invest and really where can we look to hide out and find some safety during these times. So, JR, when we're looking at the last month or so, whether it's what's going on overseas, whether it's just the different market indices, what are you really seeing that's driving these kinds of results?
Well, there's been a pretty drastic change on the tone of where things are. We've been cautious the whole year, as many of you call from December on. We thought it was going to be a slower year overall, the Fed tightening and looking to stop printing money, which the Fed did in March. But then in the last 6 weeks, it's really changed from the standpoint, nobody really expected a slowing economy. And that's really what's changed in the last 6 weeks between the China lockdown. You mentioned the war, Michael, inflation continuing to bite. All that's fed into a bigger concern of a slowdown ahead, even though currently we're not seeing it. But that's been the big change of our expectation that's new, that's kind of changed things overall from where we're going short term in the markets here.
So, Jerry, you mentioned there's not a lot of places to hide out. So we did talk a little bit about the difference between growth and value, and heading into the year end and really earlier part of this year, I think this graph shows some pretty valuable information in terms of those areas to hide out, right, as you mentioned. So as far as what the market's done and what the different segments have done, you see that really the value bias has been very strong for the first part of this year. You haven't seen nearly the level of losses as you have on the growth side, but really, if you're looking at the growth, which is the blue bar, and the value, which is the orange bar, in terms of comparison, you have an underperformance of nearly 20% in every category. And so, like you said, whether you were large, mid, or small, or international, the growth has significantly underperformed. So the area I think to some extent to hide out was in value companies that have strong earnings, strong cash flows, and don't deliver the exciting growth that you see with some of the other names, but at the same time aren't subject to some of the swings. And to that end also, I think bond portfolios have created a little bit of an opportunity because you've seen that the decline has been significantly less than what you've seen on the stock side.
And these are normal cycles that we're living in. They're never fun when we're in the midst of a downturn like the current one. But to your point, David, when you look historically, the growth and value cycles tend to be 10-year cycles, right? And you go back to the 90s, it was a growth cycle. You go to the 2000s, it was a value. The last 10 years was more of a growth. And so far to start the 2020s, it's been a value strategy over that's outperformed. And as you look ahead, just given the slowing economy, inflation concerns, you could see why that could continue for some time. And there are areas, as you mentioned, to protect yourself and where to go to hide out until there is more clarity. Because again, this too will end as we look ahead. And one of the topics we've been talking about is it's the old saying, cash is king. When you look at a downturn, we're thinking about a little differently in this current market. We're thinking more of cash flow is king, right? And when you review your investments and where things are, cash flow, well, that means companies that are buying back their stock, whether they're increasing their dividend or currently have a good dividend yield overall, or it's cash flow from outside investments, you name it. All of that helps to protect your portfolio. And again, if you're in retirement or close to it, it covers your needs, right? And one of the biggest things we learned from 2008 and 2009 is to really focus on that cash flow. The cash flow doesn't change in times like this for the most part. And a lot of the times right now, it's actually going up with interest rates higher and dividend yields higher. So with that, Michael, let's maybe look at some of the positives that are out there on things despite the decline in the market.
Yeah, absolutely. And one of the areas where we are seeing a positive is just from the wealth effect of the housing market. And as people continue to pay down their mortgages, it's sort of your forced savings vehicle. You're reducing your debt. And when you look at it, just how strong housing prices have been, it's actually been a source of a good source of wealth return for people over the past couple of years. And you're also looking at it from this just the stable value perspective. It's been a hedge against the downward equity markets that we showed those graphs on earlier. And also combined with that, wages are still going up. And so the consumers are still in a strong position. People are still spending money. And it's just really about where they're allocating those funds these days. Not doing as much on sort of the discretionary type spending, but you're still looking at staples. You're looking at, the basic necessities as, again, looking at the value stocks, value places to be, really where consumers are allocating their resources.
And when you look at this market, we've talked about this the last couple of months where it's totally different than .com, right? But there are a lot of similarities to what we're seeing right now with the drop in the market. And, with the benefit of hindsight, there are a lot of industries that over benefited from COVID, maybe pulled a lot of growth forward. And it was hard from a stock perspective. When would that growth rate slow down? Right. And a lot of that has abruptly happened in many cases in the last 6 to 9 months with certain companies. And again, when you go back to after the .com crisis and bust, right, you had a major overshoot to the upside in the late 90s and a major overshoot to the downside in the early 2000s. Right. And we're seeing signs of that overall. And it's just hard because the challenge with the slowing growth rate or negative earnings in some cases, it's really hard to forecast how low some of those company prices should go. And that's just a challenge you see in that overshoot to the downside, which is just normal. We've seen this before, and that's currently a lot of what you're seeing.
And Jared, to put a kind of a finer point on it, with some of these tech and growth names, they're just not being rewarded for what the future might hold for them, right? But as you look at the performance, in many cases, the prices are lower than they were before COVID started, and they're in a much better financial position in some cases, with 50 times the earnings that they had before COVID. So if you think about a company that we're probably most of us are familiar with, that is a popular teleconferencing application, they've had, significant growth through COVID, and their net income for the year was about $22 million in 2020, is about $500 million projected for this year. So literally that 50x multiple, and the stock market's just not rewarding that behavior, really looking for the cash flow that a company can generate. And you've seen those areas perform much.
And when you look at that too, David, I mean, when you look at a bottom and what to look for overall in the weeks and months ahead, there is historic value in this market to your example right there. The challenge is just being patient, waiting for that, because a lot of times what happens in the cycles that we're currently in is that growth stock goes from extreme growth to a value stock, right? And you look for that extreme downside where they sit with a lot of cash. And it was a market we saw in late 2002 and 2003 that you ended up buying a lot of those fallen angels or fallen growth companies that were historic value. This will be similar at some point as we look ahead. It's just a matter of having patience to get there and focus on maybe some changes in the portfolio or some small tweaks as we navigate through this.
Right. I think, JR, to your point of looking for those opportunities, other things that we would look for, whether to say, is a bottom close to being in, or have we seen that bottom, or when you see some of those smaller companies start outperforming, the relative market, it's always sort of a good indicator is, you've really kind of run out of sellers. And at that point, you've got people starting to buy again, and the smaller cap companies tend to be a little bit less liquid, so they start moving in price earlier than the larger companies. Also things you might want to look for are just decreasing levels of inflation, as well as, just generally speaking, stocks going up when you have bad news. Once you kind of get past that point, it's stocks are kind of forward looking, that could be a good indicator that we are looking at some more rosier picture.
Well, and to your point about the stock market is always forward looking. So as we're sitting here watching the decline over the last really year to date, it's a function. What is the stock market telling us, right? Initially, it was just concern over the Fed tightening, but now it's evolved into that slowdown, right? Now I think near term, it's how big is the slope? Will we ultimately have a recession? Maybe, right? Time will tell, but stock prices forecast that in. By the time you have that recession as a headline or some of those slow economic data points, Michael, as you said, stock prices tend to go up on that. That's when you know you're closer to the bottom or the turn overall. And these are the things, when we look historically of the volatile markets and recessions, everybody listening to this call has been through many recessions in their life. And this slowdown is going to be, it's not going to be the last one we go through, right? And it's a matter of navigating through and what to do, what to look for. And some of the things that we tend to do, and have done again this year is just remain cautious, right? And look to be defensive, have a little more cash in your portfolio. You don't want to time the market and be too extreme, but the time within the market, for example, right now, active managers like ourselves have the largest amount of cash in portfolio since 2001, right? And it's just looking ahead to be cautious near term, kind of waiting things out, both in the stock and bond market, because there's been kind of losses everywhere. On the other end, there's a ton of value out there. It's just a matter of when to redeploy it. And I think Michael makes some good points as to what we're looking for and when to redeploy some of that cash, because there are bargains out there, and over time that will play out very favorably.
And Jared, one of the things we've seen historically is that, especially on the bond side, and we could talk a little bit about some of the volatility recently, but there is some benefit to, depending on the pace of kind of how rates change, and we are anticipating interest rates going up. So the Federal Reserve has come out and mentioned that likely in the next couple of weeks, there's going to be a 50 basis point increase. From there, the rates are going to continue to go higher. But on the longer end, and we really see a lot of opportunities in that kind of middle part of the curve, maybe 3 to 7 years. And as we look at it, and we can jump into an example here, but you do get rewarded, I think, a little bit more for being invested in bonds and having the cash generating interest rather than waiting for rates to necessarily go higher. So if we look at kind of where bonds are, and again, this is an example of a treasury, two treasuries, right? One is a 5-year and one is a 30-year. So the blue line is the 5-year, the orange line is the 30-year. Both came out last year, and you can see, because the coupons are so low, around 0.75% for the 5-year, just under 2 for the 30-year, the price change has been pretty significant. So the 30-year has dropped significantly more because of that duration risk, which is what we're looking to avoid. And what you're able to do is to be locked into a shorter part of the curve, because a couple of things are going to happen. U.S. Treasuries, which are the safest investment instruments that we have available to us, are going to come due in 4.5 years now. So 6 months have gone by. When that happens, that price is going to be at 100, whereas it's about 91 right now. And so the 30-year has got a lot longer to go in order to regain that ground. And so keeping bonds short is going to provide, one, some upside in terms of the cash value and the ability to sell earlier if you need to, but two, you have the understanding that you're going to be getting the full payment in the next couple of years. So that provides, I think, some protection to portfolios. It builds on the cash flow that you mentioned, which can provide opportunities to take advantage of some of the lower stock prices that we're seeing ahead, and provides you a way to, again, plan for your retirement needs, which helps you avoid a lot of the disruption and kind of very sharp moves and changes in the overall portfolio allocation, because we found that pretty harmful in the long run.
Yeah, and when you look at kind of the reality of where things are, I mean, we're in an economic slowdown, in a bear market in the NASDAQ, which has just been a big drop from the previous high. So as we kind of turn, for everyone thinking of how should you think about investing right now, or what should you be doing? What actions can you take to help protect yourself, help avoid making too many irrational or emotional decisions in times like this, because they're troubling. I mean, on the one hand, if you do take it in context, market's back to where it was about a year ago, right? I mean, we've had substantial growth. Again, with the benefit of hindsight, stock prices had probably priced in a lot of that pandemic growth. And now as we price in that slowdown, it's coming back to the reality, and we're trying to set that new path. But the reality is it's back to where we were a year ago. Having said that, it doesn't make anybody feel any better about the drop, right? So it's still a tough situation we're in. So let's talk about some of the What should you be thinking right now, or what should you be doing as far as portfolio actions or such, Michael?
So I think the first thing to do, is really take a step back, take a breath, and review the financial plan. Because as we put these together for clients, we use pretty conservative returns to help us achieve our goals. And we also build into account that we do have down markets. So to really, I think, understand, again, sort of the second scenario here, that your plan's been built for volatility. So that, Jared, as you said, you could sort of rebalance gradually and take advantage of current markets and sort of say, all right, well, if we slowly start integrating some of the cash back, sort of where do we put it, move from one sector to the other, that's really what's going to be the best thing. Because you sort of have the two other extremes, where the first, in scenario one, where you allow yourself to really be overly emotional and take a action that's going to drastically change your portfolio. An example of that would be, go to a large amount of cash, whether it's 25, 50, 100% cash. And you feel good for a little bit if the market continues to fall. But as we always say, there's no bell at the bottom, and you don't know when to get back in. So historically, when we've seen clients take those actions, it becomes a lot harder for them to regain what they've lost because they never know when to get back in. On the other side, we've got Warren Buffett's famous quote, when there's blood in the streets, buy. And that's where you sort of have this other side where you're contributing all available extra cash into the market to invest in cheap stocks. On that side, though, you don't necessarily know if those cheap stocks are going to get cheaper. So again, that's why we kind of come back to that second scenario where, rebalance gradually, you would look at the financial plan and, you just sort of keep status quo moving, that, you want to have some cash on hand, you want to have more cash flow to meet your needs and, provide more, a longer opportunity for your portfolio to recover as that income keeps coming through for you.
And again, rebalancing, as we've been talking about, cash flow is king along those themes, just helps, right? I mean, it helps because when you look at the portfolio drop, if you looked at income on portfolios from a month ago or a few months ago, in many cases, they're unchanged or higher, right? And as you rebalance, it's just helped to kind of ride out the volatility over time. And then when there is clarity, when the Fed does change their tone to be a little more accommodative back to the markets, which at this point looks like it's a ways out, you still have the safer assets so you can rebalance and take advantage of the opportunities. Because in this market, there's no reason to try to kind of be a hero, so to speak, and try to catch the bottom or buy at the bottom. Our philosophy is always to do a little bit of nibbling along the way when you see kind of stocks that are overdone and such, and then into rallies continue to be more cautious. So that's kind of been our philosophy most of this year, is to continue to raise cash in the rallies, but then be mindful of the opportunities. I mean, as we sit here today, for the most part, we have the largest amount of cash in 2 years in portfolios, just to protect of where things are near term. But again, we're always mindful of the opportunities because they are here and they will come back at some point. It's just the patience of getting there, and income really helps to do that. As we look at the downturn here, what are some thoughts, David, on maybe planning or some other things to distract or reassure in this environment?
Yeah, so I think one, turning off the TV, because right, no news is good news. But I'm kidding. That's not a great approach. I think there are a couple of practical actions and things that can be done to really help take advantage of the situation. So one is harvesting tax losses. There's significant gains in the portfolios that we manage from the prior years, and really helping offset that, so you're managing your cash position as well as your tax position heading into the end of the year. Two, I think one thing that's been very beneficial and something that we've done with a number of families is, especially for those folks thinking about doing a Roth conversion, that this might be the opportunity to do that, because if you're looking at the values from prior years and the portfolio value is lower now than it was at the end of the year, it provides a good opportunity to take some of that cash, convert it to a Roth, and then get the benefits of the tax-free growth from here on out. So that's certainly an opportunity. And the last is really, reviewing your financial plan, because I think taking a pause and assessing where you are and what your needs are going to help avoid a lot of the emotional decisions. So we're available and would be happy to talk to anyone who wants to reach out in terms of where their plan is and where their portfolio is. because again, as you mentioned, JR, the portfolio income remains consistent, in some cases higher. The shift to more value and more bonds has generated more income to protect against any potential declines in portfolio values. And then the balance that you have left for growth once you've solved for your needs is to allow you to take advantage of some of the opportunities. And as the cash flow comes in, and maybe you don't need all of it, it provides you some liquidity in a structured way to move forward in the market. And the last thing I would say is, again, in the financial plan, just assess it based on your current situation, because there's no one size fits all approach. And if somebody's current situation is changing to where they might need more income, or they're nearing retirement, a lot of that's already been done and put in place. But it's, again, good opportunity just to double check and make sure that you're comfortable with the position where you are, and you're confident in the path ahead.
It's helpful with your financial plan to reassess key decisions or key purchases, because as you're revisiting things, you might delay something 6 months or a year and make small tweaks that probably aren't needed, but if they help you feel better in the short run to let the portfolio recover to then finally make those bigger decisions, it's very helpful. And it's a good time to check in, knowing that you're still okay, but then we can talk about small changes along the way. So as we close this month's kind of crazy volatile period that we're in, I mean, the good news is we've been through this so many times over the years, and we will get through this one as well. But it's just a matter of staying patient with where things are. Watch for what's ahead on key economic insights, like you said, Michael, slowing inflation, see where the Fed goes to change their tune, and see kind of how companies react. And as we start to see markets kind of change on bad news or negative headlines and such, it'd be a good sign to watch for. But meanwhile, it's just going to be more of a defensive period here for the time being, and that continues to be our mindset near term as we kind of try to focus on the long term, and we'll get there. So with that, I want to thank everyone for tuning in this month, and we'll touch base next month.